Good morning, folks. Hope everyone out there is having a good Taco Tuesday so far. Just getting this all underway, making sure that the streams are working, and then we'll fire this whole adventure off. All right, looks like everything is all set here, so we are good to get started. Thanks for tuning in. And I think this will be interesting. We've kind of had a market that's been coiling up to try to make a bigger directional move here over Globex and even during yesterday's trading. So I'm thinking we could have some kind of resolution to that. It may end up happening today. It may end up being that the market wants to wait for the big man, Jerome Powell, to make his speech. But I'm thinking that at the very least, we could have some continuation potentially to the downside today. So I think it'll be an interesting market environment to watch. So real quickly, let's get through these slides. First, don't risk more than you're willing to lose. That really is as simple as it gets with risk management. Risk management should be the focus of your trading. It should be the most important part of how you're managing your portfolio. Because if you don't manage your risk, you're not going to be able to enjoy the returns. And you've probably heard this from a number of different perspectives, and maybe it's starting to creep in to how you manage things. Maybe it's not. But what I can tell you is for folks that have been around the market for a long time, risk management is first and foremost, and that's how you can start to build your consistency. And the other side of it is if you don't have enough at risk, and I know this might sound strange, but you might not have any connection to the movements of your account. Like, let's say you have $1,000,000 account and you only have $1,000 at risk, you might not care about it. I know that might sound strange, but there's a certain sweet spot in sizing where it's not provoking anxiety, but you also care about the outcomes. Finding that spot is important. For me, it's about not risking more than 1% of my total portfolio capital on a single trade. So, speaking of me, a little about me. I've been doing this pastime, this business that we call trading for 20 years now. And it's been a very interesting journey, both of self-discovery and of learning more about the markets around us. One thing I've learned that I'd like to pass on is that one's own emotion can, not always, but can be your worst enemy. This is why I think it's important to consider how we're wired as traders, because indeed we are all wired differently. What may work well for me or someone else may not be the best fit for you, and vice versa, which is why part of that trading journey is one of self-discovery. It's really learning more about how we're wired and what mechanism to approach the market works best to build consistency. The reality is that trading is a business. We're buying and selling inventory, hoping to capture a positive spread more often than not. There are going to be losers, and the goal with that is to try to limit the size of those losers. There are going to be winners, and the goal with those is to try to ride them as long as they're working, not just cutting out at a certain percentage or a certain dollar value, but as long as the momentum's there, as long as the trade's working, keep it going. And this is something that sounds very simple on the surface level, but it's not simple in practice because most people are wired to do the opposite. We're wired to ride those losers hoping they'll come back to break even so we can get out. And we're wired to get out of those winners quickly. It's a condition that a lot of people that approach these markets deal with, whether they're investing or trading, but mostly trading. And my thought process on this is you can start to move the other way by building a more systematic approach and taking some of that emotion out of how you approach trading. Because with less emotional influence on your decisions, you're more likely to take a data-driven approach that can yield better consistency. This is what worked for me. That doesn't mean it's going to work for you, but for most of the folks that I've talked to via coaching or in our community, moving towards a more systematic approach has yielded positive results net-net. That means looking at factors like momentum, price action, options flow, sentiment and positioning, volume profile, and of course, zooming out to the big picture. What's helped me is backtesting, and backtesting in a regime-specific format. So that means, let's say I'm trying to backtest what works in a bull market. I'm going to backtest during prior bull markets. I'm not just going to blindly backtest 10 years of data. I'm going to look specifically at periods that are bull markets. I'm going to backtest the strategy during those. The same for a bear market. If you know you're in a bear market, which we're very much not, but if you know you are in one, you may be better served backtesting strategies that are having their data compared to prior bear markets. Just like long periods of consolidation, strategies that work like mean reversion, probably be better served backtesting those during long periods of consolidation. The reason I mention this is because backtesting does tend to get a fair amount of critics, but I feel like a lot of them are missing the bigger point that first, there is some near-term bias. You don't want to go back too far. You've really got to look at like the last 5, maybe 10 years with that specific regime in mind. And secondly, you've got to figure out the personality of the instrument you're testing. A backtested strategy that works on gold probably won't work on S&P, and vice versa. Now, the folks at Bookmap would like you to check out this contest they're running. I think it runs through the end of the month, the Blue Jacket contest. Share your winning setups on X, IG, or LinkedIn with the hashtag FreeBlueJacket for your chance to win over $600 in subscription value. You can learn more about that at bookmap.com/bluejacket. We also have some pretty cool deals that we're running here. The one that I'd like to share with you all, since this stream is all about Bookmap, is you can get 40% off of Bookmap visiting TraderAid.com/bookmap and scrolling down to the specials. Now let's talk a little bit about our weekly pivots. On the S&P 500 futures for the September contract, we have 64.53. This is a level that I'd be inclined to be bullish above and bearish below on a swing time frame. Then there's Nasdaq 100 futures. The swing pivot I have there for this week is 23,581.25. And of course, we have to look at the options, and the big daddy in the options market is SPX. Really one of the biggest influences on the market, if not the biggest, on a day-by-day basis. We're talking 1.3 trillion of notional traded every day in the SPX options complex, and over 50% of that expiring the same day, about 80% of that expiring within a week. So you have so much near-dated options activity. It has a very powerful influence on price discovery in the market, which is one reason we spend some time focusing on the flow and the levels. Before you find some of these key levels, you're welcome to take a screenshot of this. I'm going to do the same, take a screenshot of it and just share it on, I still call it Twitter. So I've just popped that out there on my Twitter feed. If y'all want to have a copy of it, if you didn't get a chance to screenshot it or whatever else, there it is for you. And let's finally, sorry, I went through a couple slides real quickly there. Let's finally get to the end of the slide deck so we can dive into Bookmap. The folks at Bookmap would love for you to come check out the Discord server they have. You can use the QR code on screen or visit discord.com/invite/bookmap. And I'm there every Tuesday at 9 a.m. with Back to the Futures. So I hope to see you there. Now give me a moment. We will close up the presentation and move into Bookmap itself. And on screen, we've got the S&P 500 futures contract. And we're just going to take a quick look at the overnight session. You can see really not a lot. A bit of a drop during Globex. Coming back to basically the midpoint here, we're getting to the point of control, seeing a double rejection there so far. And we've got just about 19 minutes left before the market opens here. Now, again, my baseline that I was talking about just a little bit earlier was that we've seen overall some consolidation with a heavy look on the overall chart. And this is just looking at intraday and day to day. We're not talking about the bigger picture as much, but we could be due for a bit of a pullback. And that would not be terribly surprising to see that realized this week, possibly even today. So we'll be watching that price action and just looking at the calendar today. We did get housing starts and building permits. Housing starts came in better than expected at 1.428 million versus an estimate of 1.297 million. And U.S. building permits came in worse than expected at 1.354 million versus an expectation of 1.386 million. So mixed picture in housing data. We do have Fed's Bowman speaking at 10 a.m., Trump signing a congressional bill at 1 p.m., a White House press briefing at the same time, and the Fed's Bowman doubleheader speaking again at 2:10 p.m. So that is today's economic calendar. Pretty slow overall. I don't expect too many surprises. The biggest risk factor, I think, is if Trump says anything the market isn't expecting. But that's kind of true every day, isn't it? We just have maybe a heightened potential because we know there's some chance he may step up to the mic at some point today with the signing of that bill. We do also see new tariffs coming online. I was reading some headlines this morning about new tariffs on a variety of metals. So I'm just going to pull that up here. Donald Trump stunned the logistics industry on Friday by widening his steel and aluminum tariffs to include more than 400 consumer items that contain the metal. So not the newest news, but it's starting to make the headlines. This was in Bloomberg this morning. And so this is going to be impacting motorcycles, tableware, and a number of different products. And we are seeing some signs that some companies are being negatively impacted by tariffs, such as Home Depot, where Home Depot sales fell short as high rates weighed on shoppers there. Moving over to Intel, they're getting an investment from SoftBank. I want to say it's about a $2 billion. Sorry, it looks actually it's going to be a $10 billion strategy that they're going to be looking at building. But immediately, SoftBank is agreeing to put in $2 billion into Intel. This is also among talks of the U.S. government also investing in, or as others have possibly stipulated, bailing out Intel. Intel is a company that's had really problematic management for a long time, so it's not terribly surprising to see that they're in serious trouble here. Now I'm going to take a look at the overnight session in a slightly different format here. This is my dynamic pivots chart, and we're using Motive Wave to draw this. And you can see we've just been trapped in a range. In fact, if you looked at this and you took off the bottom that shows you the time, This pretty much looks like the tape we traded yesterday during regular trading hours. I didn't trade yesterday because it looked just awful. The opening range wasn't too inspiring. The options flow, as you can see, implied a very narrow range. The most active call, 6470.50. The most active put, 6465.50. Now, these are SPX levels converted to ES, but if you see a range that narrow, it's not likely you're going to have a very exciting day. And that range actually narrowed as the day went on. And at one point, we even had the midpoint on screen, indicating that flow was relatively balanced, just telling us we had a narrow range, not really much directionality, more potential for just chop sideways. And certainly that same theme carried on overnight. So I'm looking for this pattern to resolve. I'm not necessarily certain it's going to resolve today, but I think it will resolve this week. And the longer we consolidate sideways, the larger the ultimate move is likely to be. Think of it as a coiled spring. And when that coiled spring's tension is released, it tends to move quite violently. So I'm not saying we're going to get a extraordinary move, but I think we'll at least get some excitement when this all resolves. And so far, the path of least resistance for the way this particular consolidation is setting up seems like it could be lower. In fact, even Powell coming out on Friday during his Jackson Hole speech and confirming what a lot of the market is presuming, that the Fed is pivoting more towards being willing to cut again as early as September, that may even end up being a bit of a sell the news moment. And the reason is that it's not really new information at this point. It's all but assumed. And we've seen that sell the news environment for other things, like when trade deals have come and you'd get a bit of a sell out of them because the market already priced them in as being a near certainty. It seems like we may have a similar outcome for Powell on Friday. We'll see what he says and we'll see how the market reacts, but that's my take. Got just about 12 minutes left till the market opens here. I'm going to switch back to Bookmap on screen and just zoom in a little bit. I'm also just going to quickly check on one setting here. Yep, let's make sure we're in presentation mode for you all. And we'll just increase the refresh rate a little bit. Getting some headlines over the wires from U.S. Commerce Secretary Lutnick saying we're weeks away from the Japanese and Korea deal models. And we did get a little bit of good news last night being talked about into this morning. S&P Global Ratings said revenues from Donald Trump's tariffs will help soften the blow to the U.S. fiscal health from the president's tax cuts, enabling it to maintain its current credit grade. So that's AAA plus. The U.S. did enjoy a AAA credit rating from Standard & Poor's, but that changed in 2011. And there was that whole credit rating debacle that ultimately meant very little for the overall health of our sovereign debt market and our stock market, as we know. Looking around at the broader futures complex this morning, oil under pressure. Remember, we've talked about 65.05 being a key level to watch in crude. It's trading 61.79. So it's very hard to look at this bullishly. When I was on Benzinga last week on Thursday, I talked about this just being a slow grind lower with a lot of head fakes of potentially bottoming out. Well, it's just sort of continued down that path here. Another head fake in late July to early August in crude, and really just rolling over to new lows. It looks like a 5 handle on crude is all but inevitable at this point, at least for West Texas Intermediate. So let's pull that over. We'll look at some of these charts before the market opens here. So I'm just going to pop this up in FinViz. And yeah, I'll compact that. So this is a pretty nasty chart for crude. This is looking at it on a daily chart, and you can see lower high, lower low, lower high, lower low, lower high, lower low, consolidation. Make a somewhat interesting high here, not a higher high, but at least retesting that high from August of 2024, and then we rolled over, made a new low, lower high, nasty new low, and it's just been that sort of pattern. If you zoom out on a weekly, it's much more clear how it's just been directionally trending lower. And it's a very boring grind lower. Often it's the case when crude wants to move lower, it doesn't really wait very long. It just goes right down in several violent, volatile sessions. This time, it's been just a steady, slow slide with a lot of head fakes. The last head fake took us right to the 200-week moving average. So that's a level that we should probably watch on crude futures, because you can see back in late 2025, or I'm sorry, late 2024, early 2025, we popped our head up to that 200-week and we were rejected again. And prior, that 200-week had been important support. So I'm going to look at the 200-week moving average on crude as a key indicator, because it's clear the algos are watching it, and maybe some of the trading desks as well. Let's also take a look at gold. So gold really loves hugging the 50-day. And I really, in my own way of looking at gold, I look at it through Bollinger Band squeeze breakout. So I'm really more focused on the 50-week, which we'll look at in a second. But I'll just say with the 50-day, watch it closely on gold. You would not want to see a weekly close below it. I think that could indicate that we're going to get into more of a corrective mode. I'm still overall constructive on gold because I don't think some of the drivers behind this bull market have been ameliorated. You know, global uncertainty, slowing economic activity, the presumption that the Fed is going to drop rates, and how that can make gold more attractive than some of the fixed income assets it has to compete with. All of that is bullish. Obviously, some of it is priced in, but I don't know that all of it is. So I still remain constructive on gold, but I will change that stance if we violate the 50-week, most particularly. That is this moving average, much lower here. And you can see, really, since this bull run in gold began, it has not violated the 50-week. This is where the Bollinger Band breakout began, right around here. That was the expansion that led to the overall volatility expansion that was bullish in gold. So you can also see, if you're wanting to pull this back a little bit and say, you know what, I don't want to wait till 3,000. You can look at the 20-week moving average, and gold has been pretty good about using that as a level of support as well, particularly when we saw that consolidation in later 2024. So let's watch the 20-week as a fast-moving momentum indicator on the weekly chart to gauge the health of gold's momentum. And we have silver here. Silver I'm more bullish of than gold for now. I still want to see the impossible, which is China actually doing stimulus. It seems less and less likely that it's ever going to happen because I personally believe they're fudging the numbers in their GDP. There's really no way. They've got a 5% GDP with youth unemployment so high they don't even want to tell us what the data is anymore. But we are where we are. You can, manufacture data for quite a long time in such an opaque regime. Nevertheless, I still think there is some chance we get that larger stimulus for domestic consumption in China. It is part of their overall central planning endeavor to engage the Chinese consumer for more of their economic activity to happen from internal demand. And stimulus, whether it's getting the real estate industry back on more solid footing, which could take years, by the way, or just directly trying to stimulate economic activity by giving stimulus checks to consumers, much like we're about to have happen potentially in the United States here. Something like that would be really bullish for silver. The point being, China accounts for about 15% of global industrial silver usage. So, the second largest user of silver in the world. So, as goes the Chinese economy, to some degree, the silver price follows. Copper has had a rough go. This was bid up and bid down on the idea of tariffs recently, and we've seen those violent spike ups and spike downs. That last spike down flushed out some of that long exposure. So if we zoom in just a little bit more, you can see that helped to flush out some of those longs. It's probably going to start becoming more attractive to nibble on here, but you do want to be concerned about the potential for a global slowdown because that potential is growing. We are seeing signs, particularly in the U.S., the labor market slowing down. And Fed rate cutting cycles are usually a sign of a slowing economy as well. And this time's not likely to be very different. So cautious on copper, but I do think it's been pretty thoroughly de-risked. So it could just chop sideways for a while. Palladium's been one that I've been bullish of well before this big move started, pretty much started getting bullish around here in April, May. I don't think this is over quite yet, but again, it is 100% on the health of the global economy as to whether palladium can keep running. You do see in positioning here, this is the commitment of traders. Large traders are still net short. We still haven't had folks getting net long palladium, which is one reason I'm still somewhat reluctantly bullish here, but I'd love to see it pop back above the 50-day because we can see that is a kind of important average for this thing. And we've rolled below it and we're just continuing to chop lower. So not loving the price action in palladium really in late July to early August, but I don't know that we're completely done here. We are getting to a level where we could based on prior support. So let's get back to Bookmap as we approach the market open, just about 2 minutes away. And if you have any questions about anything on your mind or what I've talked about, feel free to post them. And I'll be getting around to looking at them. I've got a couple different areas I've got to monitor because we're live on Bookmap's Discord. We're live on two YouTubes, Twitter, Substack, Kick, Twitch, you name it. We're live everywhere. And we do have a little bit more aggressive deltas coming in as we approach the market open, which is pretty usual. You could see these delta bubbles, and these are just really illustrating the aggression of either party. This is one of the most frequent questions I get about Bookmap. What are the bubbles? What do they mean? Well, they are showing you, by the size of the bubble, the aggression of either party. Green being buyers, red being sellers. It's and a measure of aggression. It's not a long short signal in and of itself. But if you see a number of green bubbles growing as your trend is becoming more positive, that can be a sign that buyers are starting to take control, for example. So I've got a question from Nathan from the Bookmap YouTube. He says, good stuff. Do you ever look at selling commodities options? I love that question because it's something that I don't think I've ever been asked. And yeah, so I do if a couple of conditions are true. First, if I have long exposure to that commodity, I would love to sell calls against that long position if the volatility gets skewed towards calls and is blown out a bit, right? So if you have a situation where, let's say, gold has an incredible run, it runs right into resistance, vol gets bid up really hard, but you're still long gold. You don't want to necessarily exit your position, but you do want to take some of the risk off the table. That's where I'd be willing to sell some calls. So let's say I was long GLD ETF. I'd be looking at some calls going out maybe 1 to 3 months, wherever in the term structure the vol is most bid and where the skew is most pronounced. And I'd be looking to sell some out of the money calls, maybe 5-10% out of the money. So yes, definitely. Oil is another one. And you could do it the other way too. You could say, hey, I've got this oil short on, right? Theoretically, and let's say it dumps to like the low 50s and vol on puts gets blown out. Selling some puts as at a price where you'd be willing to cover would be a decent way to protect that short position and to reduce your cost basis. So yes, selling options against whatever you're trading when it has an extended move, vol becomes expensive and you want to protect your position. That's how I tend to use that strategy. There is another side of it too. You could always look at, say, let's say gold has a big move lower, but you're still bullish and the put vol gets blown out and you want to get along. Maybe you could sell some puts into that move at a strike where you wouldn't be too upset to have that gold exposure put into your portfolio if you come into the money. So I do think it's a valid strategy, selling options in a number of different scenarios to include commodities. Hopefully that's helpful, Nathan. And Ships in the Markets and Mayhem YouTube saying, you are such a great teacher. Thanks for explaining so much about metals. Yeah, you're welcome. If you have any questions, let me know. And market is open here, folks, getting a little bit of a pull on S&P. You can see that larger aggression in those growing red delta bubbles. You can also see ahead of this, we did have some sell icebergs. Not too big, but some worth noting. And we talked about the potential for this consolidation to resolve lower. Maybe we're going to get some of that here. Just going to pull up the pivots chart here just to show that we're getting closer to breaking the bottom of this range we've been in. And this is a pretty chunky opening candle. It's not huge, but it's definitely a bit chunky. Basically, this is a 5-minute candle. You've almost got 10 handles in this 5-minute candle. There you go. Now you do. Pretty decent delta volume too. I show in this chart delta volume just like I do in the Bookmap chart. We're very quickly approaching the put wall here. Let's shift back to Bookmap. You can see the seller aggression is increasing here. There is some tepid iceberg buying coming through the tape, nothing too significant. But really, sellers are dominating this tape. That is the aggression you're seeing so far. And similarly, with the smaller time frame volume delta bars here, you can see similarly that aggression picking up into the open on the sell side. And remember, we talked about our weekly pivot, 64.53. We are getting quite close to that level. That would be a level where I'd be starting to look for hedges and potential shorts in some of the more vulnerable parts of the market. Doesn't mean I'd just be shorting the S&P itself, but I would be looking underneath the surface for areas that are showing relative weakness versus the broader market. And one of those trades could be something like long SPHD, or the S&P 500 large cap high dividend ETF, versus short SPHB, which is the S&P 500 large cap high beta ETF. Typically, when you have de-risking episodes, that pair trade is a very good hedge. You could see the put wall here so far offering some support. This is derived from the SPX Options Visualizer, a tool that I've built that plugs right into Bookmap via Cloud Notes. You can learn more about it at traderaid.com/SPX. And what that put wall means is you've got an aggressive amount of put exposure right at that level. And typically, those levels will act as support. If you do get crushed down through it and you see options exposure continue to roll lower, what you're seeing is the market reevaluating and moving hedges lower, moving directional bets lower, and typically that is liquidity negative. But also tactically speaking, you're seeing the larger trading desks saying they think the market could also roll lower. So that's going to be something we watch this week. Does this put wall roll lower? Do we see flows today that imply interest in lower levels of SPX? Those flows will start to show up in the visualizer in probably about 10-12 minutes. You can also see just below the put wall, there's a decent amount of bid interest, nothing extraordinary, but the confluence is meaningful. And you saw an aggressive sell attempt down here, did not pay off. Now buyers are getting a little more aggressive. So we may bounce off this put wall and perhaps get right back up to that point of control level where we know overnight that had been an area of resistance as well. Let's zoom out just a little bit to look at that session. So you can see overnight that point of control definitely providing some resistance. We do have more of these buyers that had entered at higher prices here under the session volume profile. They're off sides here. So if this thing doesn't turn around quickly, you could see more stop runs playing out as well. So we are getting that bounce off the put wall to be expected. This is an area of formidable support. It's options implied, derived, looking at the S&P 500 options chain and where the most put exposure near price is. And certainly today, we're seeing once again options playing that dominant role in price discovery. So off that put wall, already about a 7 handle bounce. I'm just going to quickly snap a screenshot of that to share. And Rohit, sorry if I mispronounced your name, my friend. Rohit sharing in the Markets and Mayhem YouTube. Incredible insights as always. Market probably holding its breath until Powell on Friday. And yes, that is definitely something we've discussed on the Trader Aid Discord as well, that it is likely that we don't get too much of a resolution to this consolidation until Friday, which for all we know may end up being a sell the news event, since the market pretty much is now, I wouldn't say guaranteeing September is a cut, but it's extremely probable. Let's look at what Fed funds futures have to say about it, since it's always a moving picture. But I think the last time I looked at it was like a near 90% certainty that there was going to be a cut. So let me pull this up and then I'll share the chart with you all. Okay, so it's come down a little bit, but right now we're looking at September as a 83.1% certainty of a 25 bips cut. So, if Powell comes out on Friday and says, "Hey, we're going to cut," it's kind of like not really a revelation to a market that's already pricing that in with pretty good odds. Now, we are continuing to see a bounce off that put wall and bid zone, getting back up to the hot put level yesterday, and we are seeing some interesting offers building above here as well. So, entirely possible we make that push. We talked about it when it was starting up just around here. Entirely possible we get back to that overnight resistance area around the point of control, which has some confluence with this call wall. And then we chop. That would be an undesirable outcome overall, in the sense that I'd love to see some more range expansion, but we got to trade the market in front of us. And I don't know that I'd necessarily be too confident we're going to move beyond that level unless we see flows online that really start to show interest in higher prices. And Rohit going on to say, take Powell at his word, maximize employment, control prices, core metrics not at 2% yet, so manageable by holding rates. Unemployment still okay, manageable, wait for data is my expectation. Yeah, I think that's reasonable. I do think he's going to come out somewhat ambivalent, but I think he's going to probably lean more towards we're getting ready to cut than, this is something we're not even considering at all. I think it'll be more approachable on the idea of cutting the way he frames it up, but I don't think he's going to give us a guarantee. He's going to say likely we need to see some more data confirm it, but we're more in the camp of looking at cuts now. And I don't know that we're going to get more than 2 this year. I agree that there's really no rush to cut, but I also think that there is an impetus for the Fed to try to say that inflation is reaching a trajectory that meets the way they model it, reverting back to 2% core PCE early next year, and perhaps they'll be comfortable doing a cut or two into that presumption, with the willingness to then also reverse course if that doesn't work out and inflation accelerates. But I am just trying to get into the head of the 200, 300 different academics that oversee these things, and then the board, and then ultimately Powell, who oversees the board, and usually it's his decision. And by usually, I pretty much mean always. Now, we are seeing a move right back up to the point of control and some resistance. So that point of control, call wall confluence area, we saw some resistance up there. So far, we're seeing a bit of a rejection. And that was the move we were expecting after that bounce on the put wall. We were talking about getting back to where the overnight resistance was, very much at that point of control. Remember, still a lot of these buyers are off sides here, so they're not out of the risk area quite yet. And so far, we're rejecting off that point of control, call wall, confluence area. We talked about that potential a little bit earlier on because it is a formidable area of resistance. Doesn't mean that, the move here is necessarily over, but it is looking heavy. So from what I'm seeing so far, you've got a decent little opening range. That could lead us to maybe some more exciting price action than we saw yesterday. I still feel like overall, the structure of this market feels a bit heavy. So it wouldn't be too surprising to see this thing ultimately resolve lower. And I'm really interested to see what the flows look like during the first hour or two in SPX, because that tends to give us a sense as to what the larger trading desks are looking for, both in terms of directionality, if there is to be any, and range. But so far, looks like we'll probably have a larger range than yesterday, and of yet, no real directional outcome. We've formed a 15-minute opening range that is tantalizing, however, and that's something to keep in mind as we navigate the trading day. This looks different than yesterday so far. And I would still consider this call wall to be resistance and this put wall to be support until proven otherwise, especially when there's confluence in both of these areas. The put wall having bids just around it and below it, the call wall having this point of control confluence area and offers growing above it, as well as a bunch of buyers off sides at and above it. Confluence is a really important part of looking at data and coming up with an analysis. I don't want to look at just one data point and get bullish or bearish off of it, because often is the case, there's other data points that add some nuance that can help you better understand the dynamics at play. And we are seeing some aggressive absorption here in the Nasdaq. This is a aggressive absorption print by sellers into that stop run. So that is a little bit disconcerting as well. And that was with the Nasdaq making a new low here. So we are starting to feel heavier, looking more likely that we get back to that put wall and we retest that level's ability to support this market. And we are starting to get some of the early flows. So far, a little bit more call heavy, but it is also early yet. And we're going to switch views for just a moment here. Go back to the pivots chart. Just to illustrate this weekly pivot down here, the 64.53. We do not want to see the market crush that level to the downside unless you have a bearish bias, in which case that's exactly what you're looking for. But this would open up the door to me wanting to put on some hedges, look for maybe some directional downside bets in some areas of the market showing relative weakness versus the broader indices, because that would give me a sense that we've got some more room to the downside potentially to resolve. Now, I'm not necessarily stipulating that that's going to happen today, but if we break that put wall, it seems all but certain. So far, we've got basically a 15-point range to watch between the key support and resistance levels implied by options. And then just below that put wall, two handles below it. As a matter of fact, you've got a key level of support derived from looking at volume profile, price action, and the way that my algo infers where these levels may be really critical. And this one, this 64.53, as you might remember from earlier in the presentation, was our weekly pivot. Now let's also go into the market a different way here, just using FinViz to go into the S&P 500 heat map, because this is always fun to look at as well. Where's the relative weakness so far today? And so far today, it is in tech. Palantir's down almost 6%. Oracle's down 3.46%. AMD down 3.2%. So you're seeing some of that weakness in tech. And where's the strength? It's overall in the more defensive parts of the market. Healthcare, consumer defensives, utilities, they all have a bid. You're even seeing a bid in materials and industrials. And energy showing some impressive resilience given the fact that oil is really taking it on the chin lately. So that de-risking that's happening in tech, that's one reason we're also seeing the Nasdaq really show weakness versus the broader market. So we'll go over to the Nasdaq for a minute. You can see it made a new session low. Let's see what that means for our overnight session here. Yeah, it took out the lows of the overnight session pretty darn easily there. And that's pretty nasty look. I mean, I know this is a longer term zoom out, but look at that, just straight up drop. Nasty business. So tech is really weighing this market down today. That is the conclusion, looking at the heat map and looking at the Nasdaq versus S&P. And we are seeing some more flows coming in. It's pretty balanced now. That's why I want to give it a little time to flesh out. But basically, the two most active calls and puts are in relative balance of each other. We'll zoom out to show that from the SPX options visualizer. And you can see the warm call. That's the second most active call, 4K. Hot call, 4K. Hot put, 5K. Warm put, 4K. So pretty much within balance. That's why, you know, things are kind of chopping sideways here as well. Options are not really giving us much directionality, but what they are giving us, at least so far, is a wider price range. You can see the call wall has evolved to become the gamma 1 level, which is a bit magnetic as well. So if we get closer to this level, we could get kind of stuck around here in the point of control. Those gamma levels are the areas on the options chain where there's a lot of call and put exposure, both sides of the chain. And those end up being more magnetic, not just sort of support and resistance like the key levels, where it's more, there's a lot of dominance by calls overhead, that's resistance, or puts below, that's support. The gamma levels tend to be more magnetic. So worth watching that we could get pulled right back into that level and consolidate a bit. Certainly, you're seeing some more buyer aggression here so far. Getting a nice continuation of that move higher here. It's overall still trading in this range, but looking like we could get right back to that point of control and hot call level here. Not too much offer interest building above there, though. So you've got a lot of the buyers, whoever is still left up here in the session volume profile, really hoping that they can get back above that point of control, and potentially one of them showing up here on the offers. One set of those buyers, maybe this is an iceberg order showing 159, or they're maybe even showing just 100 out of a larger amount. An iceberg being an order where you're hiding the total size that you want to move. So we'll see what happens if we grind up there. But I'd imagine we do have some supply around here, because when you're stuck underwater on a trade for a bit, sometimes all you want to do is break even. So sometimes when you get back to these levels where folks had been out of the money or on the wrong side of the trade for a while, the only thing they really want to do is break even or capture a few points, and they're willing to get out. So we'll see if that ends up being the case, but it implies some potential supply overhead. And we may be seeing some rotation before Powell, Rohit. That's definitely possible. We're also coming off of OPEX week, so you would think we'd be unclenched by Gamma, potentially ready to explore a wider range of price discovery. That's the other element that comes into the cards here. We're also moving further and further away from earnings season. We still have retail to report, or more of retail. We've gotten some of that, but that means there's more buyback flows coming into this market as well. We're really out of that S&P 500 buyback blackout period. Hot put flow is picking up here. This is kind of interesting. I'm just going to zoom out to show this. The hot put is registering 12,000 volume. The warm put 10,000. So between the two, 22,000 versus the warm and hot call so far, 10,000. So that's really 2 to 1. A lot more interest in downside here. Whether that's hedging or directional bets, that's a whole other matter altogether. But the overall picture it's painting is one and the same. That's a liquidity negative outcome should those flows continue. It implies that we have yet to see the lows of the day. Also have the gamma flip level on screen. So that means if we did get pulled into those hot or warm put implied levels, we'd be in negative gamma territory. Mildly, but still, we'd be going into negative gamma, which tends to be somewhat bearish. So we'll keep an eye on those flows, but it is starting to look like this move higher is getting a little bit tired. You can see the buyer aggression on the way up was pretty consistent. There was an attempt to keep it going. It failed. And ever since that failure, that aggression has been pretty tepid on the buy side. Sellers not really showing up yet, just consolidating for the moment. And got just about a minute and a half left on the stream. So I do want to encourage you all to follow me on YouTube and Twitter if you aren't already. Handle is Mayhem 4 Markets. That's Mayhem number 4 Markets. And check out what we're up to at TraderAid. Visit TraderAid.com. If you'd like to learn more about the SPX options visualizer, you can visit TraderAid.com/SPX. And check out the 40% discount we have going on for Bookmap for your first billing period, visiting TraderAid.com/Bookmap and scrolling down to the special offers. But overall, for me, as we wrap up, my feeling is the market is getting a little bit tired. And that tells me we may have a little bit of a corrective impulse. I don't think it's going to be anything too dramatic without a broader catalyst. But And I'll respect the flows and what they tell me, but my gut's telling me we've got some downside risks growing this week and into next. So I want to thank you all for tuning in to this week's episode of Back to the Futures with me, Markets and Mayhem. It's always a pleasure. I'll be back next week, 9 a.m. Eastern on Tuesday for the next episode. Wishing you all an excellent trading week ahead.